Mark, I'm going to go short right now. LIBOR is lifting. I'm sorry, I'm old school enough where I still care about 3-month LIBOR. Up we go, the moonshot. What is the significance of the short-term trust market showing higher yields?
Well, it could mean two things. One, it could mean tighter Fed policy, or two, it could mean a broader tightening of financial conditions and worsening of credit. We think it's more the latter right now. We think it's just the Fed policy that's kicking in, causing overall front-end rates to increase. And that's going to have a tightening of financial conditions, especially if you're a floating rate borrower. This is what the Fed is trying to achieve. They're trying to slow the economy down. They're trying to tighten financial conditions and borrowing rates, and LIBOR is a reflection of that.
What is your fixed floating analysis now? A coupon that is fixed and the dynamics of that versus a floaty coupon like John Farrell's more used to because it is a floaty Great Britain?
Yeah, well, look, if you're an investor, you want to be in a floating rate instrument. And if you're a borrower, you want to be in fixed. It's a dynamic where the front end of the curve is rising. We do think that the curve will invert to 10s. We think that you're probably going to see the funds rate inverted to the 5 and the 10-year point in the not too distant future. And again, that's to be expected with what the Fed is trying to do in order to slow the economy and ultimately try and get inflation under control.
So, Mark, let's reset. Let's think about where you think this Fed funds is heading, because some people have questioned that and actually brought their expectations in, not pushed them out. Where are you now?
Yeah, so the BofA house view is that the terminal Fed funds rate will be at 4 to 4.25% in the first half of next year. We think that the Fed will get to 3.5% by the end of this year and then keep going in the first half of next. Now, that's naturally going to be dependent upon the economic outlook. But as you were discussing earlier, look, we think that the economy will slow, but with the labor market this tight, we're somewhat skeptical that we're in for an immediate recession. We're well above the break-even rate in jobs growth that'll be required in order to see the unemployment rate sustainably increase. And our team is a bit above consensus. We're at 325 for the end of this week. And I do think that with a labor market that's strong, some of these discussions of an imminent recession will have to get pushed out because you really need to see the labor market slow, we think, before a recession will be nigh.
But with the terminal rate that high, Mark, wouldn't financial conditions be way too tight? Again, I spoke with Gary Schilling over the weekend, and he reacted with shock and horror when I suggested that the Fed would go to 4.25%.
Yeah, well, again, it really depends upon how resilient the underlying economy will be. We're not looking for an imminent recession. We are looking for a notable slowdown, but not an imminent recession. And we do think that the economy will be able to withstand higher overall interest rates. Now, we're not seeing that in the market today. The market has taken down the extent of Fed hikes quite meaningfully. It's priced in cuts really starting in the middle of next year and then continuing through 2024. But again, we're not there yet. And we do think that you need to see more of a labor market slowdown in order to necessarily guarantee that the Fed is going to be changing course.
How far out?
And again,
how far out do you think spreads are going to go, Mark? What should we be looking for there?
Yeah, well, we think that the financial conditions broadly have to continue tightening. That is what the Fed wants to see. They're already seeing some response from tighter financial conditions in terms of things slowing. And I'm not a credit spread analyst or expert here, but we think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation lower and for the Fed to feel like they can declare victory in that backdrop. So we're still cautious on the risk backdrop.
Mark, Michael Rosenberg and the team at Bloomberg a decade ago invented the Bloomberg Financial Conditions Index. It was picked up by the IMF within 14 days as a key barometer for them. It is now sitting at a negative 1.2 standard deviations. At what point do financial conditions have to tighten to where it changes the dialogue or the belief set, the construct of our central bank? There's got to be a tip point where they change because the facts change.
Yeah, we get asked a lot where the Fed put is. And, in terms of how far down from the peak in the equity market do we need to be? We don't think we're there yet. We've long argued that it's probably going to be 30% down, but it could be close to 40% down. But I don't think that that's what a central bank necessarily cares about. They don't care about how far have equities fallen or how much wider have credit spreads gotten. What they care about is what happens in terms of the reaction function for businesses and consumers? When do they really start to dial back? When do businesses say, we don't need that next bit of CapEx, or we don't want to hire that person? When do consumers say, I don't need to buy that next car or take that next vacation? That's the response function that they're looking for. And we're starting to see some signs of that already. But we think that there's still a fair amount that that needs to happen in order to see that dialing back in activity. And again, it's going to look like a pretty notable slowdown or a recession. But we don't think that we're quite there yet. We'll probably get there, we think, by the fourth quarter of this year or early into next year.
Mark, isn't that the horses bolted indicator? Isn't that just really late when you start to wait for that kind of stuff, evidence of it?
Well, that's what they need to see. They need to be convinced the consumer and businesses are going to be dialing back. And look, we've seen sentiment indicators that have been very, very low for really the balance of this year. And you haven't seen that response function yet. And so again, if you were going to be looking at forward-looking indicators or sentiment, you would have already thought that we're in a recession.
Sure.
Maybe we are, probably not, especially with the labor market that this is this strong. And so what a central bank needs to see is they need to see that dialing back of activity. And look, central banks typically overshoot, right? They either ease too much or tighten too much. That's probably what the Fed is going to be doing in this cycle, but they need to be convinced that they're seeing that adequate slowdown. And thus far, we're not convinced that they have.